This is King World News. I'm Eric King, and you're about to hear our exclusive weekly metals wrap with Ted Butler. Remember to go to our homepage at www.kingworldnews.com for more interviews, where this week we also have the legendary Pierre Lassonde, former president of Newmont Mining, so famous for his accomplishments in the mining and resource sector. Warren Edelman, the president of GoDaddy, which is the #1 web hosting site in the world, and certainly Warren is one of the top minds in terms of leadership in the technology world, as well as popular financial blogger Mike Shedlock, otherwise known as Mish. And in the Gold Plus section, we also have Chris Powell from GATA. Joining us now is Ted Butler. Ted, let's jump right in and talk about the commitment of traders, because you have gold near $1,100 now. Silver's still below its recent highs. It was basically 21 and change, and I think now we're in the 17 still. So we haven't seen silver take out the recent highs of this bull market. But I think in percentage terms, it's still doing quite well. But let's still jump in and talk about the commitment of traders. Where are we there?
Hey, Eric. Not a tremendous change this week. And remember that this report was as of, the one that just came out is as of the close of business Tuesday as normal. And a lot of action took place, price action to the upside this week in both gold and silver, starting on Tuesday, running through today. None of this basically is in the commitment of traders for this week, even the stuff that happened on Tuesday. There's too much of a pattern. They just can't compute and record the numbers if we get a big move on a Tuesday. We actually had an improvement in silver in that the commercial net short position did drop by a noticeable amount, 5,000 contracts or so, whereas gold was virtually unchanged. I would attribute that to the weakness that we saw in the silver price a week ago, where we closed under the 50-day moving average for about 3 days running in silver, and that caused a lot of technical funds to liquidate and dealers to buy back their short positions. That's just the rhythm and the method of the madness in the markets. We did not have a big change in the gold market because we didn't come close to the 50-day moving average. Silver was much weaker in price in this reporting week that was just released today, and that accounts for the improvement or the liquidation of contracts that we saw in silver because gold didn't have any weakness in this reporting week. There was really no change. The big question is what's taken place since Tuesday and including Tuesday through the end of the week. And from the changes in the daily open interest and price action, it looks like the dealers are adding to short positions in both gold and silver. They're not running yet. They may. I mean, they got to be feeling the pinch, particularly in gold. That was a very big move that we had this week in gold, and I'm sure they don't feel good about the short positions that are underwater. But as of yet, they haven't turned tail and run. The commercials haven't done that. Whether they do or not remains to be seen. So the commitment of traders was not a good indicator on a short-term basis, particularly for gold, but also silver this week. It's an extreme negative position still, creates high risk, but there's no way of knowing whether that high risk, a sell-off, is going to develop just because of the commitment of traders, because there's so many other things going on, particularly in gold. But it does, if we do get a sell-off, okay, it will be because of this commitment of traders structure. Whether that'll be realized or not, we'll only know in the fullness of time.
Let me ask you about the idea that India went out, their central bank, and bought 200 tons of gold. When I did the Jim Sinclair interview and we had spoken about that, and even on the air you and I had talked about that, Jim was saying basically when they're up against a country, that's when the commercials can run into trouble, and he mentioned China. But here's India buying 200 tons of gold as well. What are your thoughts when you saw that happen?
Well, I would agree. I think I agreed with it basically at the time. I remember talking with you last week. I had written an article about Paul Tudor Jones last week and his analysis of the gold market, and I followed it up this week because I thought his words were quite prophetic. His analysis, Jones's analysis, was that there is just so much money, foreign reserves, in developing countries, in the central banks of developing countries, that it was just perhaps a matter of time before they made a move on gold, and it would have a big price impact on gold. Obviously, I don't think he knew. It didn't indicate in his write-up that it was going to be India, but he did basically proclaim the fact that there was this setup where central banks could come in and and buy gold at any time, and that came to be true for fruition in this India announcement. I think it's a big thing, no question about it.
One thing that I was speaking with Pierre Lassonde about it, who's such a great mind, he and Jim Sinclair both in the gold world, but Pierre being quite legendary, obviously, for his Franco-Nevada success, which took place really during the depression of the gold sector. It was sort of amazing he was able to do that in such a bad market. But looking back on that and his thoughts on the India gold purchase was that it was a huge event, really. Because he said that the central banks were buying in the 70s as well, and now we're seeing the central banks begin to step up and begin to turn net buyers. So he thought that was sort of a monumental event.
I couldn't agree more. The one thing I will point out is that the big buyers, like in this case India buying $6.7 billion worth of gold in one shot, to put the thing in perspective, the buyers have a problem too, these big central bank type buyers, because these transactions like we've seen between the IMF and India in the past week or so are almost, these are private market, off-market type transactions. In other words, a big buyer like an India or potentially a China needs a seller. It's almost a market by appointment only. It's kind of like buying or selling a $50 million personal residence. It's not. You need one unique buyer and one unique seller. It's hard for me to imagine a central bank today, who are the big holders of gold, wanting to sell their gold in this particular environment for the very same reason that a developing country central bank like India would be interested in buying gold to diversify their foreign exchange reserve mix. That same line of thinking would seem to preclude or discourage somebody who did own a big chunk of gold to sell. And it's kind of like they have to develop a market by appointment. You have to match up a seller with a buyer. An India or any similar size gold transaction where you're talking multi-billions of dollars, they can't really come into the open market and just try and accumulate. India can't put in